You're working full-time, putting money into the market every month, doing everything the financial influencers told you to do, and you're still barely ahead of where you started. You're not unlucky. You're making 5 specific, measurable mistakes that are quietly draining thousands of dollars from your portfolio every single year. And the worst part? Most investors never find out until it's too late. In the next 12 minutes, you're going to learn the 5 stock market mistakes that cost the average retail investor over $4,000 per year in lost returns. These aren't opinions. These are backed by decades of data from DALBAR, JP Morgan, and Vanguard. By the end of this video, you'll know exactly what to stop doing and what to do instead. Let's get into it. Here is one of the most painful statistics in all of personal finance. The average equity fund investor earned just 3.83% annually over the last 20 years. The S&P 500 returned 9.65% over that same period. That is a gap of nearly 6 percentage points. Every single year, not because of bad stock picks, not because of bad timing, but because of one behavior: panic selling. This is from DALBAR's quantitative analysis of investor behavior, one of the most cited studies in behavioral finance. They have run this analysis every year for 3 decades. The gap fluctuates, but it never closes. Retail investors consistently, predictably underperform the index they're invested in because they sell when it hurts. Think about March 2020. COVID hits. The S&P 500 drops 34% in 33 days. That is one of the fastest crashes in market history. An estimated 5.5 million brokerage accounts registered unusual selling activity in that window according to Vanguard's internal data. Those investors locked in losses. Then the market fully recovered in just 148 days, less than 5 months. Anyone who sold at the bottom and waited to feel safe before buying back and missed the entire recovery. Here's what that actually costs in dollars. If you had $50,000 invested and earned 3.83% annually for 20 years instead of 9.65%, you would end up with approximately $108,000 versus $303,000. That's a $195,000 difference on the same starting amount, in the same market, over the same time period. The only variable is behavior. The reason this happens is psychological. When markets fall, our brains process financial loss through the same neural pathways as physical pain. A 2001 study in the journal Neuron confirmed that losses feel roughly twice as painful as equivalent gains feel good, a principle called loss aversion, first identified by Kahneman and Tversky. So selling during a crash doesn't feel like a mistake. It feels like relief. The fix is simple but not easy. Automate your contributions, set a rebalancing rule, and commit to it in writing before the next crash happens. Selling discipline is not something you find during a crash. You build it beforehand. Most investors couldn't tell you the expense ratio of a single fund they own. That is exactly why this mistake is so expensive. A difference of just 1 percentage point in annual fees sounds trivial. Over 30 years, it is the difference between a comfortable retirement and one where you're still working at 70. Here are the exact numbers. You invest $10,000 today in a fund returning 8% per year. After 30 years, that grows to approximately $100,600. Now you invest the same $10,000 in a fund returning the same 8% gross, but the fund charges a 1% annual expense ratio, so your net return is 7%. After 30 years, you have $76,100. The fee cost you $24,500 on a single $10,000 investment. Scale that to a portfolio of $100,000, and you're looking at a $245,000 difference in final wealth from one number most people never check. The actively managed fund industry average expense ratio is 0.68% as of 2024, according to the Investment Company Institute. Some funds, especially sector-specific or actively managed small-cap funds, charge 1% to 1.5%. Meanwhile, the Vanguard S&P 500 ETF, VOO, charges 0.03%. Fidelity's zero-index funds charge literally nothing. Jack Bogle, the founder of Vanguard and the man who invented the index fund, said it best. In investing, you get what you don't pay for. Costs are the one variable in investing that is guaranteed and predictable. Market returns are uncertain. Fees are certain. The data on active management is equally brutal. According to S&P's SPIVA scorecard, the most comprehensive ongoing study of active versus passive performance, over a 20-year period, Approximately 90% of actively managed large-cap funds underperform the S&P 500 after fees. You are paying more for a fund that is statistically almost certain to perform worse. Action step. Open your brokerage account right now and look up the expense ratio on every fund you hold. If anything is above 0.2%, ask yourself whether it has consistently outperformed its benchmark index by more than that fee. In most cases, the answer is no. Every few months, a new reason to sell emerges. A Fed rate hike, an election, a banking crisis, a pandemic. And every time, a wave of investors moves to cash, waiting for the right moment to get back in. JP Morgan Asset Management has been tracking what this costs investors since 2003, and the results are staggering. If you invested $10,000 in the S&P 500 on January 1, 2003, and held through December 31, 2022, fully invested the entire time, you would have $64,844. That's a 548% return over 20 years. Now imagine you missed just the 10 best trading days during that period. Your $10,000 becomes $29,708. You miss 10 days out of 5,040 trading days, 0.2% of the total time invested, and your return is cut by more than half. Miss the 20 best days. You end up with $17,826. Miss the 30 best days, $11,701. You are barely ahead of where you started after 20 years. Here's the part that makes market timing psychologically devastating. The best days and the worst days cluster together. JP Morgan's analysis found that 7 of the 10 best days in that 20-year period occurred within 2 weeks of the 10 worst days. The exact moment investors feel most justified in going to cash during a crash is when the biggest recovery days happen. You flee the volatility, and the volatility is precisely where the gains live. This connects to what's happening in markets right now in 2026. Earlier this year, JP Morgan downgraded Indian equities, which caused a significant pullback in certain indices. Investors who panicked out of positions during that correction missed substantial rebounds in sectors like technology and commodities. There is a famous quote often attributed to the investing world: "Time in the market beats timing the market." It's a cliché because it is empirically true, backed by study after study. The average holding period for a stock on the New York Stock Exchange was over 8 years in the 1960s. By 2020, it had fallen to under 6 months. As holding periods shorten, behavioral mistakes compound. This one doesn't show up on your brokerage dashboard. It doesn't alert you when it's happening. But tax drag, the cumulative cost of investing in the wrong accounts or failing to optimize your tax strategy, is one of the most expensive invisible mistakes in personal finance. Let's start with account placement. If you hold a high-dividend stock or a bond fund in a taxable brokerage account, every dividend payment is taxed as ordinary income in the year you receive it, even if you reinvest it immediately. Move those same assets into a Roth IRA or a traditional 401(k), and that tax disappears. Qualified dividends and capital gains inside a Roth grow completely tax-free forever. According to Vanguard research, proper asset location, putting the right investments in the right accounts, can improve after-tax returns by 0.75% per year without changing a single investment. Over 30 years, 0.75% per year compounded is the difference between $100,000 growing to $1,627 versus $854,000. That's $146,000 lost to an organizational mistake, not an investment mistake. Then there's tax loss harvesting, selling positions at a loss to offset capital gains elsewhere in your portfolio. A Wealthfront study found that consistent tax loss harvesting improved after-tax returns by approximately 1.55% per year. On a $200,000 portfolio, that's $3,100 every single year that goes back into your account instead of to the IRS. Over a decade, compounded, that is over $40,000. Most investors also misunderstand the Roth versus traditional IRA decision. If you're in a low tax bracket today and expect to be in a higher one at retirement, paying tax now via a Roth is mathematically superior. A 2024 Fidelity analysis found that over 60% of investors under age 35 who could benefit from a Roth IRA are instead contributing exclusively to traditional pre-tax accounts, likely costing them tens of thousands in retirement tax bills. And capital gains timing matters. Holding a stock for 366 days instead of 365 converts a short-term capital gain taxed at your ordinary income rate. potentially 22% or higher, into a long-term gain taxed at 0%, 15%, or 20%. That single day can save you thousands on a large position. In 2021, investors poured billions of dollars into Cathie Wood's ARK Innovation ETF. ARKK peaked at $159 per share in February of that year. By the end of 2022, it had fallen to $30. Investors who put a significant portion of their portfolios into a single thematic fund, one that had posted extraordinary returns in 2020, watched decades of wealth building evaporate in less than 2 years. This is concentration risk, and it destroys more wealth than almost any other single mistake. Concentration risk doesn't just come from buying a single hot fund. It shows up in multiple forms that most investors don't recognize. The first is home bias. American investors hold approximately 79% of their portfolios in U.S. equities, according to the 2024 Vanguard Global Perspectives report. The U.S. represents roughly 60% of global market capitalization. That overweight creates unnecessary geographic concentration, and historically, international markets outperform the U.S. in roughly 40% of rolling 10-year periods. The portfolio that ignores international exposure is the portfolio that misses entire cycles of global growth. The second form is employer stock concentration. A 2024 Fidelity report found that 33% of employees with company stock in their 401(k) hold more than 20% of their retirement savings in a single company's stock. When Enron collapsed in 2001, employees lost approximately $1.2 billion in 401(k) value because it was concentrated in company stock. When Lehman Brothers filed for bankruptcy in 2008, employees faced the same catastrophic double loss. Their jobs and their retirement savings vanished simultaneously. The third form is sector concentration. An investor who holds VOO, QQQ, and a tech sector ETF may believe they're diversified, but QQQ's top 10 holdings overlap significantly with VOO's top 10 holdings. During the 2022 tech sell-off, both indices fell sharply together. Real diversification means exposure across sectors, geographies, market caps, and asset classes. The rule is straightforward. No single stock should represent more than 5% of your portfolio. No single sector more than 25%. And at minimum, 20–30% of equity exposure should be in international, developed, and emerging markets. This isn't exciting. It doesn't make for a great story, but it is the strategy that survives every market cycle. If this video saved you from making even one of these mistakes, that decision is worth thousands of dollars over the next decade. Every week on this channel, we break down the strategies, data, and frameworks that serious investors use to build wealth systematically. Hit subscribe and turn on notifications, because the next video is going to cover exactly how to structure a portfolio that survives any market cycle. The algorithm will not always put this in front of you. Subscribe now so you don't miss it. Here is your one action for today, not this week. Today, open your brokerage account and look up 3 things: the expense ratio on every fund you hold, which of your dividend-paying assets are sitting in taxable accounts, and what percentage of your portfolio is in a single stock or sector. Write those numbers down. That audit takes 15 minutes, and the information it gives you is worth years of compounded returns. Wealth is not built through a single great decision. It is built by eliminating the small, chronic, invisible leaks that drain your returns every year while you're not watching. You just identified 5 of them. The compounding starts today. Stock market mistakes, investing mistakes, beginners, personal finance, wealth building, investing tips 2026, financial freedom, passive income, how to invest in stocks, stock market for beginners, retirement investing, index fund investing, tax loss harvesting, expense ratios explained, financial independence, compound interest description. Are stock market mistakes quietly draining your wealth every year? In this video, we expose the 5 biggest investing mistakes costing the average retail investor thousands of dollars annually, backed by hard data from DALBAR, JP Morgan, and Vanguard. From panic selling during market crashes to ignoring tax strategy and paying excessive expense ratios, these are the wealth-destroying behaviors most investors never recognize until serious damage is done. Whether you're just starting your investing journey or you've been building wealth for years, these financial freedom fundamentals apply to every portfolio size. Topics covered: panic selling statistics, expense ratio impact, timing the market, tax loss harvesting, concentration risk, index fund investing, Roth IRA strategy, and building long-term passive income through disciplined stock market investing. Subscribe for weekly personal finance and wealth-building strategies built on real data, not hype. Personal finance, investing tips, wealth building, stock market, financial freedom.